So there's a new ETF in town, and none other than the Lion-OCBC Securities APAC Financial Dividend Plus ETF, which advertises at least 5% payout for the first 2 years. Is it worthwhile to invest in this ETF? That's exactly what we're talking about in this video. But looking at what the ETF is all about, its underlying index performance till date, the associated fees, and finally key points that investors should note about this ETF. So let's get started. Now the ETF provides investor exposure to 30 Asia-Pacific banks and financial institutions. Looking at the ETF sector breakdown, we see the majority of it is in the banking industry, followed by insurance and investment services. In terms of the ETF geographical composition, it is split into countries such as Japan, Australia, Singapore, Hong Kong, South Korea, and Malaysia. When it comes to ETF's constitute weightage, the top 10 holdings make up around 56.2% of the ETF and contain notable companies like Singapore's 3 local banks, China Construction Bank, and Mizuho Financial Group. Now that we know what the ETF is roughly all about, let's take a look at the performance of the track index and the associated ETF fees. In terms of performance, the IH APAC Financial Dividend Plus Index has an annualized 10-year net total returns of 6.1%. Do note that these returns account for both the market price and dividends that were paid out. When it comes to index dividend yield, it ranges from 4.2% to 5.8%. Thus, the advertised ETF payout of at least 5% for the first 2 years is the exact median yield of this range. In terms of associated ETF fees, the advertised management fee is 0.5% per annum. However, investors need to note that the maximum expense ratio can be up to around 1.44% after accounting for other various expenses. With the index past performance and ETF fees covered, let's move on to the key points that investors need to note about the ETF. First up, the advertised payout of at least 5% for the first 2 years. From the get-go, the product page clearly mentions that distributions are not guaranteed. So why even advertise this 5% payout thing at all? My guess is that the ETF issuer will honor this advertised 5% payout for the first 2 years, meaning that investors will receive an annual distribution of at least 5 cents for the first 2 years. The portion of distributions not being guaranteed is most likely referring to underlying constitutes, where there is no guarantee that they will dish out dividends consistently. In the event that distributions received from the underlying constitutes are not able to hit that 5 cent distribution threshold for the first 2 years, the ETF will then cover the shortfall by distributing out of capital gains or capital. Thus, if distributions are made out of capital gains or capital, the net asset value of the ETF will decrease, thereby resulting in a fall in the market price of the ETF units. So this is something that investors should take note of. Whether this will occur in the first 2 years of ETF listing will highly depend on the interest rate environment and the subsequent net interest margin pressures that the banking industry faces. Put simply, if interest rate remains elevated for longer, there's a higher chance that dividends for the ETF constitutes are able to hit that 5 cents threshold without needing any distributions out of capital gains or capital. Of course, after the second year, there will be no more payout threshold, and any distributions henceforth will likely mirror that of the dividends dished out by the ETF underlying constitutes, net of any related expenses, taxes, and fees. Do also note that at least 5% distribution payout would be in effect from September 2024 to September 2026, and the distributions are paid out quarterly. Moving on from distributions, another factor to consider will be the foreign currency risk of the ETF. As per the ETF's prospectus, the ETF issuer currently don't have any intent to hedge for foreign currency exposure, but may do so in the future via passive financial derivative instruments should it result in an efficient portfolio management. Given that the ETF distributions are in Sing dollars and only 20.4% of ETF are Singapore stocks, foreign currency risk could have a significant impact on the ETF's overall performance. This is even more important when the currency in question has mostly depreciated against the Sing dollar in recent years. Besides foreign currency risk, another aspect to note will be withholding taxes. Currently, all of the countries that ETF exposure to, only Japan and South Korea have withholding taxes imposed on dividends flowing to Singapore. With both countries withholding taxes at 15%, any dividends received from Japanese and South Korean stocks will automatically be subjected to a 15% cut. This could thereby negatively impact the ETF's total returns, as dividends contribute a significant portion of it. Moving on to the last point that investors should know about the ETF is that a couple of the ETF's major constitutes are trading close to their all-time high values in recent years. The likes of the 3 local banks, KB Financial Group and Sumitomo Mitsui Financial Group, just to name a few, are all trading close to their 52-week high market values. Thus, Investing in the ETF right now might not be the best thing to do given the possibility of a decrease in market value of the ETF units due to the market correction. Also, if interest rates are expected to go down by the end of this year, this could put further pressure on the market prices of the ETF constitutes and correspondingly the value of the ETF's units. After considering every aspect of the Lion-OCBC Securities APAC Financial Dividend Plus ETF, I do not think it's a great investment to make. While the dividend yield is attractive, it does not outweigh the other shortfalls of the ETF. Also, if you're a dividend investor looking to gain exposure to the banking industry, you'll be better off investing in some of the ETF constitutes directly to avoid any withholding tax and also limit foreign currency risks. For Singapore ETF investors looking to gain global exposure, you'll be better off investing in world ETFs domiciled in Ireland, as they provide better historical returns and at a lower cost too. You can check out my previous video over here for some of the ETFs I look at as a passive Singaporean investor. In any case, if you still intend to invest in a Dividend Plus ETF, the deadline to apply for it will be 2nd of May, 12 PM. Do also note that the minimum amount required is $2,000 if you apply through OCBC ATM's digital app or the internet banking portal. Else, it will be $50,000 if you're applying through other trading platforms. Alternatively, you can always wait for the ETF to be listed on the market before investing in it. You may just get a cheaper price than its initial issue price.